This is chapter 16, where we'll be discussing management accounting. We all are familiar with the Coca-Cola symbol that was made many years ago, and Asa Candler purchased the business and therefore the symbol for $2,300. Now that company is huge. It's throughout the world. We mention this because Coca-Cola employs thousands of management accountants in hundreds of companies to help support all the decisions that they make. The basic framework of management accounting is really to do three things. It has three principles. Decides who has decision-making authority. It provides information to support decision-making. And then it helps to evaluate performance. And so these three are kind of the principles that govern how management accounting systems are designed. So talking about this, so now we're going to kind of cover more detail on this, but who has the decision-making authority? Who should be assigned? Who gets to decide what? And is it going to be in job descriptions, exactly what authority they have, verbal instructions from supervisor, maybe a little less formal, or even in internal accounting documents and reports. We know that managers need information and rely on that information, and management accounting helps provide that. Now they have historical information to talk, what is our costs? What do things cost us to produce? And they also do forecasting to figure out the productivity and costs to help make decisions. Should they be buying higher quality equipment or lower quality equipment? Should they invest more in people and training? Just exactly where they should provide that. And that is all based on information that typically comes out of an accounting system. So to understand that, we understand a value chain where value is created at each stage of the process of creating and delivering either a product or service or both. There is a management accounting system framework. This is what we've just been talking about, that we're assigning decision making, deciding who gets to make it. We support that decision making with information, and then we evaluate how well someone has performed. And so you can kind of see this information that comes out of the system to support this. Now, we immediately want to trade off between financial and management accounting. You've probably already taken financial accounting. You recognize there's GAAP, there's rules. It's usually a year or a quarter or a month, and it's primarily for external parties. But management accounting is different in that it is internal. It is within the company to support the decisions made by the company itself. And so you can see there's really no standards. It's simply answering management questions. It could be for any period. It could be for any component of the value chain. And the users are management and sometimes customers and others, suppliers in the value chain. But typically internally is how this is going to be used. So management accounting does have some professional certifications. Usually we talk about the CMA, the Certified Management Accounting, as an exam that's provided, and then a designation as a Certified Management Accounting or a Certified in Strategy and Competitive Analysis. So these are some professional certifications that can be provided. In summary, management accounting systems assign decision-making authority, make and support decisions, and evaluate and reward performance. So that's kind of the setup. To do so, we're going to use data analytics. So data analytics is the process of using data to address accounting questions or business questions, especially within a management accounting framework. We call this framework the AMPS Data Analytics Model. The AMP stands for A, ask the question, M, master the data, P, perform the analysis, and S, share the story. So we can see the steps that are provided. Management has questions. We know and understand how to use, how to load up the data, and then we analyze that data by performing the analysis. And finally, we're going to share the story. We're going to report what we found. And this is kind of what this looks like. Notice here it's an iterative model. Once we've asked the question and we work to answer it, this might lead to more questions. And we can continue to refine these things as we go. So as an illustration of the AMPS model, let's assume that Cisco, that makes many of the routers used in homes and businesses, they're going to decide whether to manufacture its own most basic and cheapest router or to outsource the manufacturing process to a third party. So the question is, will Cisco be more profitable if it outsources its low-end routers or if it manufactures it itself? And so what it can do is get relevant data of what it would cost internally. There might be some overhead. There's going to be cost of materials. There's going to be quality control, employees, and so forth. Or if it's easier just to outsource it, not easier, but cheaper or more profitable to just outsource this to another company. And so that we'll find relevant data to do that. What kind of analysis will we do? Well, we'll determine, will Cisco be more profitable one way or the other? And where is the point of our indifference? Especially if it's all a cost issue. This question was kind of slated based on the cost or profitability, but the question might be refined otherwise and say, when does it make sense to do one or the other? And then figuring out how to communicate or share the story with decision makers. Figure out the implications, maybe not only profitability, but maybe then a more refined question is, what are the pros and cons of doing it ourselves or outsourcing to another manufacturer? There are 4 common types of questions. So as we get to the ask the question stage, we recognize there are 4 different types of questions. The first is what happened or what is happening. We call that descriptive analytics, but this is starting to say, what is our question? Okay, what was the cost of 1 pound of chicken produced by Tyson last year? That's what happened. Why did it happen? Is it more than we expected? Is it less than we expected? Is it higher than budget? Is it lower than budget? Why is that? And then what do we think it'll be in the future? Are we going to forecast it? What would be the cost of chicken in the future? Will it be higher? Will it be lower? Are we more efficient? Are we less efficient? And then what should we decide to do? Should we make contracts with more farmers and produce more chicken? Or should we have less? How are we going to optimize our performance? Now, this types of questions readily leads to the type of analysis and the type of data we're going to collect. But this starts us thinking about what is the type of question which then leads to the analytics that needs to be performed. We can see some details here. We can look and see, here's my AMPS model, AMPS. But we can also see the stakeholders across the top. So these would be 4 users or 4 types of stakeholders, 4 stakeholders that make and have different questions. So managerial accountants or management accountants might have different questions than the costing department, which is different than the marketing and production, which is different than the C-suite executives. And they're going to make and have some different decisions and some different questions and some different processes to answer those questions in terms of the AMPS model. Okay, and so the management accountant, at least the example we provided here was, hey, what has past performance been in the costing department? What is the composition of cost, fixed versus variable versus mixed? What is that past performance been? And then these types of questions, an example of this would be predictive. What is our forecast and what is our break-even level? And these are kind of looking into the future and seeing what that might look like. And so you can kind of see these stakeholders, how their types of questions might lead to a set of analysis. We also want to think about sharing the story. We might want to say, hey, if we want to view anomalies and outliers, maybe we're going to use some conditional formatting. How about the composition of the whole? So what proportion of sales comes from each of the 3 major product lines at Caterpillar? Well, typically proportions are shown in a pie chart. Summarize distribution of values. How many days on average did it take Amazon to fulfill a set of 20,000 orders? So you have 20,000 orders. Some took 0 days. Some probably took 50 days. And probably most of them took 2 to 3 days, 1 to 2 to 3. And so we're going to do a histogram to show that. How about showing a trend? Well, we're going to use a line graph to show a trend. So the past trend of Ozempic sales from Novo Nordisk, how much of that trend is expected to continue into the future? And then showing relationships between values, like the relationship between R&D expenditure and sales at Moderna. And we're going to show that in terms of a scatter plot, so you can see what that might look like there. We want to talk some about manufacturing companies and what how they would use management accounting. Typically, they're going to track their costs, like the cost of raw materials, wages earned by production workers, and a variety of other costs that we might even call overhead costs. Things like the cost of electricity or utilities. What does it cost to maintain the equipment? What are the property taxes, or examples of others? But management accountants require reliable manufacturing cost information to answer these questions. What sales price should we charge to earn a reasonable profit? Is it possible to lower the cost of production in order to be more price competitive? Is it less expensive to buy certain parts used or to manufacture these parts ourselves? Does it make sense? Should we automate and use a robotic assembly line? And so we rely on reliable, useful, complete cost data. How does that cost come? Well, there's two types of costs. There are prime costs, and those are, so you can see both of those are direct. The direct cost, direct labor, okay? And then conversion costs says, what are the costs to convert materials to the final product? And the conversion costs are going to be direct labor and manufacturing overhead as we start to define what these look like. So we want to classify these different costs. So direct materials are those raw materials and component parts used in production that are directly, key here is directly traceable to the products manufactured. So if I have a computer and I want to see what the direct materials are, then I would probably say, what's the cost of a hard drive? I see it in there. There's a hard drive. That is directly traceable. Direct labor is going to be the wages and other payroll costs of employees whose efforts are directly traceable to the products. So whoever puts this computer system together, those costs, those direct labor costs would be directly traceable. Okay, the third category is manufacturing overhead. And manufacturing overhead is kind of everything else, everything but direct materials and direct labor. Well, why do we need any of those? Well, there's some electricity. Can you tell how much electricity is in each computer system? How about supervisor salaries? Well, they may or may not have ever touched the computer, but they're supervising and telling people, hey, we need more of these. Hey, work faster, work slower, work maintaining quality. How about when the equipment breaks down or even the depreciation on production? So you can see these are very indirect. They're not directly traceable to the product, and we need to be able to track those. And so we think about the physical flow in production. There are some direct materials purchased, like a hard drive, right? And we store those and have those there. And then we say, well, some of them we're going to use, and we're going to put into the final product, the finished goods. And we're going to use, so we have direct materials, and we also have direct labor. And if we go back a couple slides, we'll see that direct material and direct labor are our prime costs. So that's reflected here as prime costs. And so here are these products. And then we're going to take these to convert direct materials into finished goods. We need both direct labor and manufacturing overhead. And so we can see those are our conversion costs to convert direct materials into finished goods. Finally, some of them we sell. And so those will be our goods sold, and ultimately cost of goods sold would be included there. Well, what are examples of product costs? Well, resources consumed to create inventory. Okay, so those are going to be our three costs: our direct material, direct labor, and manufacturing overhead. Notice this first chapter, we have quite a few definitions to get through, but this is going to be reported as inventory on the balance sheet until the goods are ultimately sold. And when those goods, that inventory is ultimately sold, the cost is going to be moved or transferred from inventory to cost of goods sold. We're going to differentiate now product cost with period costs. And period costs are something that's incurred typically to sell a product. It's kind of all other costs that are not part of product costs. And so the cost of selling that inventory, general administrative expenses, for example, the accountant are typically general administrative expenses, right? Interest, well, we had to have debt to finance the inventory or finance the equipment, and income tax expense. This is recorded as an expense in the income statement where it occurred as an operating expense, and it's going to be separate from cost of goods sold. The difference here, if we go back one slide here, is product costs. We see the product costs, and it's going to sit in inventory until it's sold. Once it is sold, then it's going to hit the income statement as cost of goods sold. But period costs are expensed in the period they are incurred. And that's the difference. Product costs might be stuck or parked in inventory, whereas period costs are going to be charged immediately, recorded as an expense that period. And so we can kind of see what this looks like. So our product costs are going to show up in inventories on the balance sheet, but when they're ultimately sold, they're going to show up as cost of sales or cost of goods sold. Whereas the period costs, and we can see the selling, general, administrative, other, show up as operating expenses. This note, it's not part of cost of goods sold, but those would be included here as our operating expenses. And so we can see what the difference is. So let's look at these ethical statements here. Financial reporting associated with environmental remediation is complex. All right, so here's the example. Suppose a manufacturing company discovers that machinery at one of its plants is polluting the groundwater. To avoid penalties, the company has agreed to remove the machinery, dispose of it properly, remediate the groundwater, install new machinery, and go through some inspections. The entire process is expected to take 2 years and cost millions of dollars. The question is, where should those charges go, right? And so let's see what the decisions look like. Over the 2-year period, the company will charge most of the costs to an asset called deferred environmental remediation costs. Okay, these deferrals will eventually be added to the cost of new machinery. Once they're included as the cost of machinery, they're going to go through depreciation and be allocated to inventory as product costs. Okay, so that's how we've chosen to charge that essentially. And so, and we'll note that there's going to be some matching. So if you go back to your financial chapter, hey, whenever you recognize revenue, you're probably going to line it up with expenses. And so this is going to show up there. But we have some choices. We might be able to write it off as period cost, but it really belongs to product because it was the cost of the machinery to build the inventory, and that should be included as a product cost. But you can kind of see that responsibility there. Now, as we have product costs, we need to think about the matching principle. The matching principle governs this distinction between product costs and period costs. Now remember, product costs should be reported in the income statement only when they can be matched to produce revenue. So when that inventory is sold, what are we doing? We're recognizing both the revenue and the product cost via cost of goods sold. So note this says this ensures the income statement properly matches sales revenue with the cost of each sale. So how much did we get when we sell it? What was the cost of each one we sold? And so that matches it appropriately. So here's an example. Consider a real estate developer who starts a tract of 10 homes. During the year, the developer incurs material, labor, and overhead costs amounting to $2 million. By the end of December, none of the houses have been sold. How much of the $2 million in construction costs should appear in the developer's income statement for the current year? And the answer is none, because that $2 million is going to show up as inventory and will only show up in the income statement when those houses are eventually sold. So that will match the sales revenue with cost of goods sold. So we can see that there. All right, so what do the inventories look like for a manufacturing business? Well, all right, manufacturers have raw materials or materials inventory, work in process. So these are, hey, we've started working on them, but they're not done. And we have some that are in finished goods inventory that are ready to sell. So we include that. All right, so what do the cost flows look like? Well, we have our debits and our credits, right? So direct materials purchased shows up as an asset. That's raw materials, right? But then we start to use some of those materials. So we're going to move them out of materials inventory and put them in work in process inventory. And that's going to include both our direct labor costs. That's going to include manufacturing overhead until it's completed. And then once it's completed, we're going to have our cost of finished goods sitting in finished goods inventory. And then once it's ultimately sold, that will show up via cost of goods sold. So let's go ahead and illustrate this accounting for manufacturing costs. Let's see, Conquest manufactures high quality mountain bikes, and the company relies on cost information to monitor its production efficiency, right? How fast are they making them? To help them set prices to make sure they're profitable and to maintain control over its inventory. So that's what it does. So here are the cost flows, and this follows, this from a couple slides earlier, right? And so we're going to have raw materials. Here's all of our raw materials here. Some of them we use. And so this is going to go from direct materials used into the work in process. We have payroll of $292,000. Well, the direct labor costs applicable to production are $300,000. And so we can see what that looks like, that direct labor costs $300,000. Okay, so that's what that looks like. All right, now we have manufacturing overhead, these indirect costs, and these get applied to overhead as well. And so here is what we've invested. Here is what we have finished. So we're going to move these $800,000 to cost of finished goods. And we sell 782 of them. And that's what's going to show up in cost of goods sold. So you can kind of see what those look like. Direct materials, again, are those raw materials and component parts that are directly traceable, are an integral part of the finished products. They might include, for this company, lightweight alloy tubing, brakes, tires, pedals, shifting levers, sprockets, all those items. Typically, you can see them. It's directly traceable, so you can see those. We also have indirect materials. Okay, this is going to show up as manufacturing overhead, bearing grease, welding materials, cleaning compounds. We're not going to be able to actually see how much grease is there. It's not going to be a major component part. How about welding materials or cleaning compounds? Really hard to trace these. And notice it says these indirect materials cannot be traced conveniently or directly to the finished goods manufactured. Okay, so the direct material cost flow. Okay, we've actually looked at this in terms of the T accounts and so forth on earlier slides here, but the cost of direct materials is debited to materials inventory account. Once it's placed into production, it leaves materials inventory account and goes to work in process. And we're going to do that by debiting work in process, right? It's an asset, it's a debit, and we're going to credit materials inventory. And then the balance remaining in the materials inventory account at year end represents the cost of direct materials on hand and ready to use. So some of it we transferred out, right? We moved it into production, but some of it is still sitting there and has not yet been used. And so that's the cost of direct materials on hand, ready to use when production starts the next year. All right, direct labor. Well, these are our employees, and they're working directly on this. And Conquest says, I've got 5 categories. I've got cutters, welders, painters, assemblers, and packers. And each of these are direct laborers. They put together. You can see the impact of what they've done in order to deliver the final product. We also have indirect labor. So these are the supervisors, the maintenance workers, the forklift drivers, the security guards. They all make a salary as well, but because it's indirect labor, you can't actually see that labor. The factory supervisor did not put together the mountain bike. The forklift driver did not put together the mountain bike, etc. But those are still charges of doing business. And so we're going to move those into manufacturing overhead, right? So the direct labor is going to be recorded throughout the payroll period, but the debits are not recorded until the end of the payroll period. So we're keeping track of this as we go throughout the period, okay? Manufacturing overhead. This is everything but the direct materials. And so all of our indirect materials, all of our indirect labor will be classified as overhead, and we're going to assign these products a portion of that manufacturing overhead. Okay, and so there are many types of overhead costs, and we'll certainly cover them as we go through the book. You can kind of see what those look like. Examples of manufacturing overhead. Well, indirect materials, indirect labor, plant occupancy costs. So we might have to pay rent, might have to pay electricity to be in the plant, to turn on the lights, to run the equipment, any machinery and equipment costs, and then costs of regulatory compliance and so forth. So it's not possible to prepare a complete list because there's all sorts of indirect costs that are included, but here are a few examples. All right, how do these costs flow? Well, we track these, we keep track of these, and every time there's a charge, we charge it to manufacturing overhead as a debit. Okay, and then once these have been consumed by production activities, we're going to allocate these costs. We're going to transfer these costs from the manufacturing overhead account to the work in process. So you see both direct labor, direct materials, and work in process all charge or a debit to work in process. Again, that's an asset, and we're going to reduce our manufacturing overhead asset. In the course of the year, all the overhead costs incurred should be applied to units of product manufactured. Okay, thus at year end, the manufacturing overhead, all those costs should be allocated. Okay, all right, direct versus indirect manufacturing costs. And we've kind of been talking about this, but there's direct material, direct labors, that's our direct costs. And we have some indirect manufacturing costs. And so that's manufacturing overhead. And this is going to be, we're going to establish a method of allocating this to each product manufactured. Work in process inventory. There's where we accumulate manufacturing costs that show up. And that's for all the units we've worked on during the period. And we're going to allocate that cost between units completed and moved to finished goods or transferred to finished goods, and those that still sit there partially completed at the end of the period. Finished goods inventory, again, is going to be where we put the costs of the finished goods. They're ready to sell, and once we do sell them, they'll move from finished goods to cost of goods sold. So we can kind of see the order process there. So let's assume we are the CFO of Conquest and we've received an income statement. And in your conversations with Jim, the plant accountant, you learned that in the recent reporting period, plant manager Darlene asked that inventory transportation costs, the cost of repairing the plant parking lot, and the newly installed plant landscaping costs all be allocated to the cost of production. In addition, when these allocations took place, the plant produced more bicycles than were sold, creating significant increases in the amount of inventory on hand. As a result, most of the costs described by Jim have been assigned to the inventory on hand, but have not been assigned to cost of goods sold. Furthermore, during the recent reporting period, both Darlene and Jim earned significant bonuses based on plant profitability. What, if anything, would you do as the CFO? Well, you want to make sure that these are product costs and not period costs. So you're going to look really carefully, even though it's plant landscaping, did that have anything to do with manufacturing? We do have a cost of repairing, but the cost of repairing typically would not show up as the plant, right? That wouldn't be manufacturing costs to repair the plant parking lot. So these should be period costs, which would reduce income and thus might well take away that bonus. So we have to work carefully and make sure we're following appropriate rules and allocation between period and product expenses, right? So we look at these and we see, okay, we started with work in process of $30,000. We incurred these particular costs. So our total manufacturing cost was $810,000. Okay, so the total cost, so the beginning plus what we incurred was $840, but by the end of the year we only had 40, so the cost of finished goods manufactured was $800,000. Now, once we have the cost of finished goods manufactured, we can go and look and see how much went to cost of goods sold. So where does this work? Here's this 800,000 from cost of finished goods manufactured, and you can see that showing up here is 800,000. So 150 plus 800 is 950, less what we still have in inventory and haven't sold yet. The difference is going to be our cost of goods sold. And so we can see how that shows up. And so this cost of goods sold that we've computed of 782 is going to show up right here. So we sold 1.3 million. We had cost of goods sold of 782,000. Sometimes you'll see this will say cost of sales, especially when it's a service, right? Because there aren't any goods sold in service. So we can see here our selling expenses, our general administrative. Here's my period expenses. So here's income from operations, interest, income before taxes, and net income. So I can see what that looked like. I can also provide a partial balance sheet that will show what our inventories should be. So we're going to go back a few slides and look at the materials. I like to call them raw materials, but materials inventory, work in process, and finished goods. So 20, 40, and 168. So let's go back here just a little bit. And looks like I don't have directly anywhere tracked my my materials inventory, but work in process inventory at the end of the year was 40. So let's go ahead and check this and see if this is 40. There it is. And finished goods looks like it was 168, and there's my finished goods inventory of 168. So I can see what that looks like, and so I can see my composition here. All right. I'm also noting that we sold our products for 1.3 million, and 190 still was not collected yet, but we think we'll be able to collect that.